Imagine waking up one morning to headlines screaming that physical silver is selling for over $100 an ounce, not on some fringe website, but in real transactions where bars and coins are changing hands, while the paper price on your screen still insists everything is calm. That kind of disconnect doesn't happen by accident, and it doesn't happen overnight. The question is not whether silver can reach those levels, but what hidden switch could force it there, and why so many people would be caught completely off guard when it happens. To understand how physical silver could ever trade above $100, we have to start by separating two worlds that most investors assume are the same. On one side, there is paper silver, futures contracts, unallocated accounts, ETFs, and derivatives that represent claims on silver rather than silver itself. On the other side, there is physical silver, the metal you can hold, ship, store, and deliver. For decades, these two worlds have moved closely enough that most people never question the link. But history shows that when stress hits the system, that link can stretch, distort, and in extreme cases, snap. Think of it like a theater that has sold far more tickets than it has seats. As long as most people are happy to watch the show on a screen at home, no one notices. The moment everyone shows up at the door demanding a seat, the illusion collapses. Silver is uniquely vulnerable to this kind of stress because it is both a monetary metal and a critical industrial input. Unlike gold, most silver is consumed. It goes into solar panels, electronics, medical equipment, chemical catalysts, and countless technologies that modern life depends on. Once it's used, much of it is not economically recoverable. At the same time, silver's above-ground investment stockpiles are relatively small compared to gold. That means the buffer between supply and demand is thinner, and thinner buffers break faster when pressure builds. Now enter the Federal Reserve, not as a villain twirling a mustache, but as a central actor whose policies shape the financial environment silver trades in. When people hear the Fed's hidden trigger, they often imagine a secret meeting or a single announcement. In reality, the trigger is more like a chain reaction set off by policy decisions that seem technical and boring until their consequences collide. Interest rates, balance sheet expansion, liquidity facilities, bank regulation, and collateral rules all quietly influence how metals are financed, stored, and delivered. One of the least understood pieces of this puzzle is how rising interest rates and tighter liquidity can actually destabilize the paper silver market. When rates are near zero, it's cheap to carry large short positions in futures markets. Banks and trading houses can sell silver they don't own, roll contracts forward, and fund the positions with minimal cost. But when rates rise, that carry cost increases. At the same time, regulators often demand higher quality collateral. Suddenly, maintaining massive paper positions becomes expensive and risky. If you are a large institution and your choice is to post more cash, more treasuries, or reduce exposure, reducing exposure starts to look attractive. This is where physical demand matters. If industrial users, mints, and investors are simultaneously asking for delivery, the system feels stress from both sides. Futures exchanges are designed to net out positions, not to deliver metal to everyone who asks. Historically, only a small percentage of contracts ever result in delivery. But if confidence erodes and more participants decide they want the real thing, inventories start to drain. We've already seen moments where registered silver stocks on major exchanges fell sharply, raising questions about how much metal is actually available versus how many claims exist against it. The Fed's role becomes critical when liquidity dries up elsewhere. In past crises, the Fed has stepped in with emergency facilities, repo operations, and balance sheet expansion to keep markets functioning. Those actions are meant to stabilize the system, but they also send a powerful signal. When the central bank creates liquidity to solve a problem caused by too much debt and leverage, it reinforces the idea that currency units can be created more easily than real goods. Over time, that perception pushes investors toward hard assets. Silver, being smaller and more volatile than gold, often reacts later but more violently. There's also the issue of confidence in pricing itself. The spot price of silver is discovered primarily in futures markets, not through physical transactions. That works as long as participants believe the futures price reflects real-world supply and demand. But imagine a scenario where mints are backordered for months, premiums on coins explode, and industrial buyers are willing to pay almost any price to secure supply, while the futures price lags behind. At that point, the futures price becomes less a signal and more a suggestion. Physical silver starts trading at its own clearing price, one determined by availability, urgency, and true. History gives us clues. In 1980, silver briefly touched levels that, adjusted for inflation, would be well above $100 today. More recently, during periods of financial stress, Premiums on physical silver have surged even when spot prices fell. Those episodes were smaller versions of a much larger potential disconnect. They show that when fear meets scarcity, price is no longer just a number on a screen, it becomes a negotiation. So what is the hidden trigger? It's not a single rate hike or press conference. It's the moment when Fed policy, intentionally or not, forces participants to choose between paper promises and physical reality. When funding costs rise, collateral rules tighten, and trust in counterparties weakens, the incentive shifts toward owning what doesn't depend on someone else's balance sheet. If enough players make that shift at the same time, the paper market can no longer suppress the signal coming from the physical market. That's when prices can move in ways that seem impossible just weeks earlier. The key takeaway for now is not to fixate on a specific dollar number, but to understand the mechanics that could make such a number plausible. Silver doesn't need everyone to panic, just enough pressure at the right points in the system. The Fed doesn't need to announce anything dramatic, just continue policies that expose how leveraged and fragile the paper structure really is. When those forces align, physical silver stops behaving like a derivative and starts behaving like what it actually is, a finite, essential metal that can't be printed, rehypothecated, or promised into existence forever, because the real world doesn't run on contracts and spreadsheets. It runs on tangible metal in hand, in vaults, and on factory floors. When enough people start demanding physical silver instead of paper claims, the supply-demand imbalance hits like a shockwave. Imagine a river with a dam holding back the flow. The longer the dam holds, the more pressure builds behind it. Paper markets act like that dam, suppressing short-term price signals. But once the dam cracks, the release is rapid, chaotic, and often surprising to those who only watch numbers on screens. This is why premiums on coins and bars can spike to multiples of the futures price almost overnight. Retail investors often see this as a crazy market, but in reality, it's the market correcting decades of artificially suppressed signals. Liquidity in the financial system plays a massive role in how fast that river rises. When banks and brokers face margin calls or increased collateral requirements, their ability to supply metal to the market diminishes. Futures positions that previously rolled smoothly can suddenly demand immediate physical delivery. Dealers scramble to locate available ounces, and if inventories are thin, the pricing mechanism shifts from abstract contracts to actual scarcity. Historical examples like the silver squeeze in 2011 demonstrate this vividly, where premiums on physical silver soared even as the COMEX spot price moved more slowly, showing a clear divergence between paper and real metal. Analogies from commodities like oil or rare earths show the same pattern. Once the physical market is tight, speculative or derivative positions lose their power to dictate the price. Another layer is industrial consumption. Unlike gold, most silver is consumed and doesn't return easily to the market. Electronics, solar panels, medical equipment, and chemical applications all gobble up silver at astonishing rates. In times of industrial expansion or shortages, every ounce matters. Unlike a currency, silver cannot be conjured at will. The Fed can influence money and credit, but it cannot create physical silver out of thin air. So when financial leverage and paper speculation reach their limits, physical reality asserts itself, forcing a repricing event that can be sudden and extreme. Geopolitics and central bank holdings also amplify this. Countries with strategic reserves of silver or gold, or even industrial metals policies, can act in ways that tighten supply unexpectedly. When multiple nations move to secure tangible resources, global markets experience a ripple effect. This is especially true when the US dollar faces volatility, because silver is priced in dollars globally. A weakening dollar combined with tighter supply acts like a multiplier on physical silver prices. This is why analysts often point to Fed balance, ET expansions, interest rate moves, and regulatory changes as indirect but powerful triggers. They influence confidence, liquidity, and ultimately the willingness of holders to part with metal, shaping the entire landscape for both investors and industrial users. There is also a psychological component. Markets operate on perception as much as fundamentals. When rumors circulate that silver inventories are shrinking, or that delivery backlogs at mints are worsening, fear and urgency can drive behavior that accelerates price moves. Physical silver reacts faster to such sentiment than paper silver because it represents something tangible, something that cannot vanish with a spreadsheet entry. This dynamic has been documented repeatedly. During crises, Premiums on coins and bullion bars can rise hundreds of percent, signaling that participants value possession over contractual claims. Understanding this interplay between human behavior, policy, and physical scarcity is key to recognizing why 100 plus silver is not science fiction. It is a plausible outcome if these forces align. The Fed's hidden trigger, therefore, is really a combination of mechanisms: tightening liquidity, rising interest rates, regulatory pressures, and subtle shifts in market confidence. Each alone might seem inconsequential, but together they create a pressure cooker environment. When large institutions are forced to cover positions, when industrial buyers demand delivery, and when investors question the reliability of paper markets, the market moves from a virtual equilibrium to a reality-based one. The cracks in the system appear in physical markets first. Coin and bar premiums explode, dealers ration supplies, and suddenly prices that were theoretical become urgent, real, and record-setting. Investors can also look at historical analogies in silver's behavior to anticipate triggers. In 1980, when the Hunt brothers attempted to corner the silver market, they discovered that liquidity constraints and regulatory interventions could violently amplify price swings. The COMEX and global markets learned lessons about delivery obligations and margin requirements that still influence today's system. Yet, while those events were extreme, today's financial system is vastly more leveraged, interconnected, and dependent on trust in paper instruments. That magnifies potential volatility if the hidden trigger activates again. Understanding the chain, from Fed policy to derivatives leverage, to industrial demand, to actual delivery constraints, is essential for anyone trying to anticipate silver's future. Finally, it's worth emphasizing the duality of silver as both an investment and an industrial commodity. Unlike gold, which serves primarily as a store of value, silver's dual role means that even modest shifts in industrial consumption, mining output, or investor behavior can produce outsized market reactions. A sudden surge in solar panel production, an unexpected shortfall in mining output, or regulatory changes affecting banking leverage all interact with investor psychology and the Fed's monetary environment to create conditions where $100 silver is not just possible, but perhaps inevitable under certain circumstances. When this alignment occurs, paper markets may temporarily lag reality, and premiums on physical ounces can soar, capturing the true scarcity and value of silver in the tangible world. Premiums on physical silver can soar, capturing the true scarcity and value of silver in the tangible world. And yet most investors are still watching a screen that says one thing, while reality screams another. This divergence between paper prices and physical demand is where opportunity and risk converge. The moment large industrial users, mints, or savvy investors begin hoarding physical silver en masse, the lag between futures contracts and real-world metal widens. Dealers start to ration, premiums balloon, and suddenly, what was theoretically possible becomes unavoidable. Imagine a luxury car dealer who only has a handful of limited edition vehicles. When demand spikes, the listed sticker price is irrelevant, because buyers will pay multiples over it to secure the actual product. That is exactly what can happen with silver, only on a global scale. The mechanics of this process are subtle but crucial. Futures markets, leverage positions, and rehypothecation chains create the illusion of liquidity. A single ounce of silver can represent dozens of claims across multiple institutions. This system works perfectly in calm conditions but is fragile when stress builds. Rising interest rates, regulatory tightening, and collateral demands all increase the cost of maintaining these chains. When institutions are forced to unwind positions, the paper market can no longer mask physical scarcity. This unwinding acts like a flash flood, cascading through the system and driving prices in physical markets far above the theoretical spot price. Historical patterns such as the silver spikes in 2011 and the Hunt brothers' attempt in 1980 illustrate that this process is neither random nor unprecedented. It is a predictable consequence of structural vulnerabilities combined with behavioral dynamics. Central banks and geopolitical factors add another layer of complexity. Silver reserves held strategically by nations, industrial hoarding, and shifts in mining output can amplify pressure on supply. When combined with Fed policies that influence liquidity and investor confidence, these factors can converge into a perfect storm. For instance, if the dollar weakens while global demand for industrial silver rises, foreign buyers will compete fiercely for ounces, driving premiums even higher. This is where the Fed's hidden trigger concept becomes tangible. Not a single action, but a combination of policy moves, market stress, and behavioral responses that together create conditions for dramatic price movements in physical silver. Education and awareness are CRI. Tickle. For anyone looking to navigate this environment, understanding the difference between paper and physical silver, knowing how futures markets work, and tracking inventory levels at exchanges and mints are essential for anticipating potential shifts. Questions like, how much registered silver is available versus open interest, or are premiums on coins rising faster than spot prices, can provide early warning signals. Investors who understand these dynamics can position themselves advantageously, while those who focus solely on digital prices risk being blindsided when premiums explode. It's also worth noting that silver's dual role as both an industrial metal and a store of value gives it unique volatility. Unlike gold, which is almost purely financial, silver's consumption in technology, medicine, and energy sectors means that supply constraints can have immediate and profound effects on the market. A sudden surge in industrial demand, even if temporary, can trigger ripple effects that extend to investment markets, exacerbating price spikes. These interactions between tangible supply, industrial consumption, and paper markets create the environment where $100 plus silver is not fantasy, but a plausible outcome if multiple stress factors align. Finally, the human element cannot be underestimated. Markets are psychological as much as they are mathematical. Rumors, perceived scarcity, and fear can accelerate movements in physical silver far faster than in paper markets. Once participants believe that supply is insufficient, behavior changes. Buyers are willing to pay premiums, hoarders hold back stock, and delivery chains tighten. This self-reinforcing feedback loop is exactly what drives physical silver prices well above paper valuations. Understanding the interaction between Fed policy, market mechanics, and investor psychology is crucial to anticipating these moments, and the lesson is clear. When the hidden trigger is activated, physical silver prices will reflect reality, not theory, in a way that can astonish even seasoned investors. The stage is set for potential upheaval. The Fed's hidden trigger, when combined with industrial demand, regulatory tightening, leveraged positions, and human behavior, could transform silver from a market quietly trading on paper into a tangible, high-premium asset in global demand. Investors and observers alike must recognize that what appears stable on the screen may mask deep, systemic pressures underneath. The divergence between paper and physical markets is not just a possibility, it is a predictable outcome of structural mechanics, policy decisions, and behavioral patterns. Those prepared to understand and navigate this divergence may find opportunity, while those unprepared may only witness the chaos from the sidelines. Silver is at a pivotal intersection where tangible scarcity, industrial demand, and financial leverage converge. The Fed's policies, ranging from interest rates to liquidity provision, interact subtly with market mechanics to create a hidden trigger capable of propelling physical silver prices far above paper valuations. Historical precedent, combined with the unique dual role of silver as both an industrial commodity and a store of value, shows that significant divergence between paper prices and physical demand is not only possible, but increasingly plausible. Understanding the structural vulnerabilities in futures markets, the implications of rising premiums, and the behavioral dynamics of investors and industrial users is essential for navigating this complex landscape. Ultimately, when stress hits the system, physical silver asserts itself as a finite, tangible asset whose price reflects real-world scarcity, liquidity, and confidence, demonstrating that in the realm of precious metals, reality always catches up with perception.